So I promised I would be bringing you some bad news. Am I doing okay so far? I want to talk about something actually a little more positive, and it appears to have nothing to do with real estate. It's about what's going on in the U.S. on shale oil and gas. We have a newsletter at our website. You're more than welcome to download it. But essentially, the U.S. is changing dramatically. It eventually will be the top oil producer in the world, and it might actually, if you take into account the impact of natural gas liquids, already be there by the end of this year. The U.S. production of oil and natural gas equivalents is increased by 8 million barrels a day over the last 8 or 9 years. And that means their deficit, their trade deficit, eventually over the next few years will more or less be cut in half. It will also mean that from a manufacturing perspective, a lot of companies are reshoring or coming back to the U.S. and creating a lot of very, very good paying jobs because the U.S. has this huge benefit from an energy perspective. This is the price of natural gas in Asia, the Mediterranean, the U.K., and the U.S. That's a huge energy win for the U.S. And even if they build all of these LNG plants, and the same is true for Canada, it won't change the fact that there's a significant cost to ship LNG. There'll always be a domestic price advantage for energy in North America for a long time to come, especially with natural gas in particular. So shale gas has allowed the U.S. to go from an importer to an exporter. It depresses North American prices, unfortunately, if you're an investor in this. We need LNG plants to basically get the gas offshore for prices to actually stabilize and start to rise, but there'll always be this homegrown advantage. And America has another major benefit, and this also is another reason why we're very bullish on, in relative terms, on U.S. real estate. They have a huge demographic advantage, much better birth rates than China, Europe, Japan, and Canada. So basically, they are replacing their population, and their average age of their population is not increasing nearly as fast as these other countries. This is the average price of the US dollar compared to other currencies, and it's been in a slide for a long time. Our guess is that's going to change. And that means that another reason for Canadians to seriously look at US assets is because there is likely to be, and there is already occurring, a shift in currencies. This is a graph that came from Barron's, and I had it updated showing the home ownership rate. This is at the peak of the housing bubble in the U.S., where basically by making cheap loans, they were able to get everybody to get to 69, 70% ownership in real estate. That's been dropping, and every time it drops by 1%, 1.2 million households are looking for a place to rent. And that doesn't take into account the 80 million echo boomers that are also primarily going to rent for the first 5 or 10 years of their working lives. So that's why we invested in multifamily residential in the U.S., and Wayman's going to describe in detail how some of those assets look. Another big picture issue is this is the commercial real estate index in the U.S., which went up and also crashed and has recovered some. But when it started, our dollar was 62 cents. As of, well, unfortunately today it's down to 94 cents. When I did the slide, it was 96 cents. It means then, as a Canadian, when you're buying commercial assets in the U.S., you are basically paying the same price as you would have paid in 2001. So it's different. Because we're buying with a dollar that has greater value, it means that we're buying assets that, from our perspective, are at a discount. This is the price change in Canada, which I referred to earlier. So basically, the capital value, if you ignore the income component of Canadian real estate, our prices are up 75% in Canada in the same time frame that they're up 0% to a Canadian in the U.S. So that's another reason for us being there in a bigger way. So let's talk about rising interest rates and what they might do. These are 10-year bond yields when we hit the nadir of the interest rate cycle in March of this year. And 10-year bond rates in the US, Canada, Germany, Switzerland, and Japan. And as we look forward to see where things are going, as of today, these are where these bond yields are. Virtually every country except Japan, and the only reason Japan's interest rates haven't gone up is because they're doing everything to make sure that their currency isn't worth anything. So it's very important for them to try to get their interest rates as low as possible, which they've accomplished amazingly well. So the real question is, how much higher are these interest rates going to go, and when is that going to happen? And what difference does it make to your assets? So let's take a look at the last 60 years. If you invested in U.S. corporate bonds, high-quality corporate bonds, so not much different than government bonds, your rate of return would have been about 6.5%, 3.5% after inflation for the entire 60-plus years. But there are two 30-year periods of time. For the first 30 years, up to 1981, when interest rates got to 18%, and I know that there's an awful lot of younger people in the room that weren't around here, or if they were around here, they were still in diapers in 1981. So they just remember this as a story their parents told them. You should have experienced what it's like to have a 20% mortgage. It's sort of that kind of story we got from our parents about walking to and from school 5 miles each way without shoes uphill in the snow. So nobody actually believes these things actually occurred. In the next 30 years, interest rates have gone from 10.5%, or the returns have gone 10.5% and 7.5% after inflation. Biggest bull market in bonds in history, and it's completely over. So part of the issue is what happens then in the next 30 years? Are we going to see a replay of what happened from 1950 to 1981? So these are the portfolio changes as a company overall, some to do with real estate, some not, that we've made as a company. We've shortened the duration of bonds that we do buy. We put more into higher yielding, low risk-adjusted commercial mortgages. Global bonds, because interest rates are better in other jurisdictions. Reduced our exposure to REITs. Looked at the quality of high-yield bonds and locked in mortgage rates for longer periods of time on real estate. So it's a defensive approach. The idea is to say, we know something's going to happen, so we don't know when it's going to happen. We're not even sure what the quantity is going to be like, but we know it's not going to be positive for the returns on fixed income assets. So will they be negative for real estate and equities? Well, they might be if essentially it's a result of stagflation. If it's like the 1970s, it will be negative for both real estate and for equities. If the reason we have higher interest rates is because we have a stronger economy and actually an increase in the rate of inflation, then in actual fact it will be positive for equities and real estate. Now let's take a look at this. This is the long-term interest rate cycle. And the real question is, we're here on the right. Are we going back to 1981 in interest rates or 1961? And it's more likely we'll go back to 1961, because if you decided that you wanted to research interest rates, and I can actually recommend a book that will give you the detailed interest rate history of mankind going back to the Babylonians. So if you would like a copy of that book, just leave a card up here and I'll make sure you get one. If you don't want a copy of that book, you'd find that if you took a look at that line and ran it back, say, 1,000 years, it really wouldn't change. There's been a very tight range of interest rates. This aberration that occurred in the 80s is an exception and very unlikely to occur again. It's possible, but it's unlikely. This next graph you're looking at really is a comparison between those same interest rates, which have declined, obviously, since the 70s. You can see that same peak in the declining interest rates. What you see here is the cap rate. The cap rate of a building, this is the cap rate of real estate in the US, is really just the income rate of the building. And that drives the price that the building will sell for. And back in the late 80s, cap rates were 6.5% to 7%, while mortgage rates were 10 to 11%. Today, cap rates are 5.5% to 6.5%, and mortgage rates are 4% for 10-year money. So basically, the cap rates have dropped 1% in this 25-year period of time, but mortgage rates have dropped 6 or 7%. So there's a connection between cap rates and interest rates, but it's not a linear connection. If interest rates go back up 1% or 2%, then other rates cap rates are not necessarily going to follow.